Tax Time, Episode 2, Using Real Estate to Save Taxes. Watch this episode to know 3 ways you can use investment real estate to save taxes. Hi, I'm Amol Heda, helping you define real estate for your portfolio. And I'm with Keller Williams Bay Area Estates here in Bay Area and author of Thriving Through Ownership. It's tax time, exciting time. We file our taxes, and when we do our taxes for the whole year, we come to know how much we are paying, where we are paying, and for those that are analytical, they try to understand what it will take to save their taxes. And I bet most of you that are working with a tax advisor, you will know what will help you save taxes. This episode, I'm going to talk about 3 ways you can use real estate in your portfolio to save taxes. Let's go straight in. The first one, a lot of expenses from an investment real estate are tax deductible. So first thing, so when you buy investment real estate, you take a mortgage on it. And the mortgage has 2 components. One is principal and the second is the interest. The principal goes back to repay your mortgage. So that's not an expense. So even though you part with the money, you don't see it with you, it goes and parts itself as reduction in liability or the reduction in the loan balance on your mortgage. So next month you are paying interest, you don't pay interest on that portion of the principal that you paid back to the bank. Number 2, so now that the principal is out of the way, let me list all the items that you can write off as expenses when you are buying investment real estate. Last week we talked about renters not knowing their tax deductions. This week we are going to talk about homeowners who know how real estate has helped them save taxes and grow their money, want to do more of it by doing investment real estate. And so when you buy an investment real estate, you end up writing off the interest, the property taxes. These are the 2 that you can write off even on your primary home. But remember, you are capped out to how much you can write off. Whereas in investment real estate, you can write off everything that you pay against these. Not just that, you can write off all property management, all maintenance of the property, and a portion of some of the upgrades that you do based on how the tax code allows you to write those off. Additionally, you can write off depreciation. Now, why do I bring depreciation separately? When you write off depreciation, you are not actually giving that money away to somebody else. It's a notional expense meant to help you to replace the property once it reaches its useful age. So depreciation is not money that you took and paid off to somebody else. You are in fact collecting that with you. So essentially what is happening is that depreciation, instead of being an expense, it's a collection of money with you only. And remember, real estate appreciates, not like a car that the value goes down each year. So even while your real estate is appreciating, you are collecting and keeping this money with you. So that's one other factor. Additionally, you can write off expenses that you take for education, traveling to and from the property, to do the management, maintenance, visit, oversight, and whatnot. Does that kind of help you understand what all can go in to write off expenses. That's nice. The second item that you should remember is we can write off the interest on the mortgage. Of course, I told you just now in item number 1 about mortgage interest. But there are a lot of people that believe that paying interest is a sin. Little do they realize that if they are not paying interest, they are going to pay that money to taxes. So let's list again how real estate expense and profit works. So on one side, in the income, you have rental income, any washer, dryer, laundry, anything that you might have in a real estate, and anything that some of those people that charge for parking have it. So all these and any miscellaneous income on the property. But the expenses are interest, property taxes, management, maintenance, depreciation, and any other miscellaneous expenses that are used for property management. So there will be very little left to actually go and account for as income for your taxes. Now let's talk about the third item, and that's about saving by reducing your earned income and pushing your money towards capital gains. Now this is a complex way of thinking, and bear with me while I explain this to you. So follow me now. Taxes on earned income are taxes like the federal and state. Currently, California, the highest tax bracket is 11.3, the state tax, okay? And the federal tax, the highest bracket at this point in time is 39%. So between the federal and the state, the highest tax bracket is 50%. Half the income is gone before you get it. So those in these highest tax brackets, if they were to buy a property full cash and they were to get a $10,000 rent on an investment fourplex and they did not have interest to write off as expense, say $5,000 were to be the interest, they would be paying taxes on the entire $5,000 at 50%. How much taxes would they be paying? $2,500 on an interest saving of $5,000. So what's the right way? To borrow from mortgage, paying the interest. So if you are paying the interest, you don't pay the taxes, and that's your saving. Now, what also happens is because you took depreciation, the depreciation, if you were not to take depreciation, this would have added to your income. So say the depreciation on the property was $2,000 and $5,000 was interest. So $5,000 plus $2,000, $7,000 would go towards your income without protection. And if you made $7,000 at 50% tax bracket, you would be paying $3,500 in taxes. Now, the capital gains tax is barely 20% or somewhere there. 30% for taxes on earned income, 20% for taxes from capital gains. So visualize this, that if you can make some of your earned income go away and use that for make it go into the capital gains bucket, which is what depreciation helps you do, which is what interest helps you do. Because the more interest we pay, the more money we hold to ourselves. And in that case, you can buy more investment property, and so you can make more income disappear from your earned income into your capital gains income. That's how you reduce your tax burden. I am not a tax advisor. I'm not a CPA, so I'm not qualified to talk about taxes. Please note, you need to go work with your awesome CPA or a tax consultant that you trust. But these are design ideas again that you can consider, analyze your portfolio, take these to your tax consultant and see how you can put these to work for you. Go to your trusted tax consultant. That's the best way for you to win. Do you think this was helpful? If you need more details, reach out to me. If you want tax consultants that can help you, reach out to me. If you want more help buying real estate, follow a lot of articles that I will be showing on this channel. And there are topics about leverage, there are topics about taxes, and a lot of it about real estate and how to buy. I hope this was helpful. Thank you. Bye.